Welcome to the Big Money Questions show. I'm Rachel Rickard-Strauss. I'm personal finance editor at This Is Money. This week, why do asset prices move? They do all the time, but what is behind it? We are lucky enough to have Eric Lonergan here to talk us through it. He is a macro fund manager at M&G Investments, and he's also an economist and an author. Eric, thank you so much. Can I start with the big question first of all? Why do they move?
Well, first of all, hi. Good to see you again, Rachel. Why do asset? I think it's a fascinating question to which I don't have all the answers. But maybe just also why I love it as a question is you hear on the radio, on the news, on the TV, you read in the newspapers all the time that sterling did this because of this, or the stock market's done this because of this, or the bond market gilts, and presupposing that is that we actually understand why these things are moving. But when you pin people down and ask them, you get very, very incoherent answers. So it's not at all clear that we know why they're moving. And that's why very often you get, when people do express a view about how it might respond, so if you think of something like Brexit or the election of Trump, those were supposed to be disastrous events, and indeed the initial reaction of a lot of prices was very negative, but very, very rapidly they were reversed. So we don't really understand, even when we assume something is negative, when it actually occurs, we can be very surprised by the way the asset price moves.
Maybe we should go back even further to look at what is happening when markets move. Is it just people buying and selling shares? Or what's going on? Okay,
well, that is yet another great question. So you will frequently in market culture hear people using phrases like more buyers than sellers, which seems sort of an obvious truism, like a grocery store or somebody trading commodities, where if you've got more wheat, if there's a bumper harvest, you expect the price of wheat to fall. And for sure, in goods and services, supply and demand are huge determinants of price in that logical way. But asset prices are very, very different, because sometimes the price can move without anything changing hands, right? So, for example, if you imagine you and I are market makers, and market makers are market participants who will make a price, they'll quote a price for you in a security. And let's say we're buying and selling shares in Lloyds Bank. Now, the point is, so we will make a price for somebody. So if somebody comes to me, I'll say, I will buy it at this price and sell it to you at this price. I'll make a price for you. Now, a piece of news can come out.
So just to be clear, you're like the middleman there. It's not that here on one side we've got someone who has Lloyd shares, on the other side we have someone who wants to get rid of them, and so then they sort of do a deal and...
That's right. I will just offer you a price. So me as a fund manager, I can go to a market maker, and and if I want to buy or sell shares in Lloyds Bank, they'll make a price for me. Now, what can happen is, if this major news comes out, like the Bank of England changes interest rates, which is perceived to be relevant to the profitability of Lloyds Bank, they will make me a different price. So the price will actually have changed instantaneously without any shares changing hands. So this is what's fascinating in a sense about asset prices, because they are about beliefs, perceptions of risk, interpretations about the future. And if any of those many things change, the price can change. The point I was, there's a classic example of this is when a stock market crash occurs. One of the interesting things that typically on stock market crashes, so people will say, well, there was more sellers than buyers because the market crashed. Of course, you typically get very high volume, you get a huge number of transactions in market crashes. By definition, there were the same numbers of buyers and sellers, right? Because who would you have sold to? So actually, for whatever reason, and this is what's really interesting about it, a vast number of people wanted to buy the stock market on the day that it crashed, and a vast number of people wanted to sell it. All that changed, of course, was the price.
And the price drop in crashes is a great example, I suppose, of the irrationality of these things. That sometimes it'll be the case that yes, something's happened, and investors respond to that. But other times, the news behind a move can be negligible.
Absolutely, and there are other examples, things like the flash crashes. I think one of the things I find very interesting about those phases is precisely because they happen very rapidly. It's not so much that they're irrational, but I think they're non-rational, in the sense that you don't have enough time to reason. And I think that's why factors like emotion, instincts, even if you look at brain activity during those phases, it's fight and flight, fear of scarcity. Because it's happening so quickly, you can understand, panics are often associated with things happening rapidly. So I think there's very different human interpretation, very different human behavior is involved when things are happening rapidly. You don't have enough time for considered judgment if you see the price moving very rapidly.
Often markets are spoken about with human characteristics and emotions, and to anyone who's not in that world, that can seem really odd. When you hear on the radio that markets have been spooked, or that the fear there's a contagion of fear in markets, that seems really weird. But the way you're describing it, perhaps that's not such a bad interpretation of what's going on, because it is being driven by a group of people's emotions, which happen to be moving in one way or another.
Well, that's right, but I prefer your latter description of it, that it's people's emotions that are moving it, because I personally don't find it very insightful when we say things like markets expect this, or the market believes, or markets think, because it in a sense takes it away from human understanding, as if the market is some kind of autonomous thing, which I don't think it is. So, for example, if you think during the Euro crisis, people would say, well, the market is attacking, the Italian bond market. Well, really what's happening is human beings with their savings are extremely nervous and scared. And so it is down from individual investors, people with pensions, peoples with deposits. So I think attributing this thing to the market can sometimes undermine our understanding. I personally would prefer if we're explicit about what's causing these prices to move in a way that people can actually relate to. I mean, everybody can relate to a situation. If you think of something like Northern Rock, you're legitimately concerned about the financial safety of your deposit. And that's what was happening during things like the Euro crisis. That is typically, these are understandable sets of beliefs and emotional reactions, even if they are panics or extreme or emotional in some way.
Markets are often seen as the perfect way of pricing something, because all of the information that is available about a particular company or an economy is out there. People are analysing it, and they come up with the best price to reflect that. Then at the same time, there are lots of people who make money from the discrepancy between what they believe should be the price and what it actually is. So how do we reconcile the two?
It's very hard to reconcile the two. So there is a theory known as the efficient markets hypothesis, which is a much smarter theory actually than it's often portrayed. It's often stereotyped as being obviously ridiculous because you get bubbles, and we clearly have phases with hindsight, and even during phases that appear to be highly irrational, which is inconsistent with this idea that the market is some forward-looking mechanism that has discounted all of the information and is always behaving appropriately. So that, I think that stereotype isn't very helpful. That's too easy a criticism. But there's two strands to it that are interesting. One is about whether you can beat the market or not. And that we should come back to, because that is actually a very powerful hypothesis. So, because what you find is the two schools of thought, if you take the behavioral finance school that thinks markets are full of irrationality and emotional behavior, versus the efficient markets that says it's a kind of perfectly rational mechanism, they both actually don't really believe that you can beat the market in any sense, reliably. And so they're both quite skeptical about that. But there's a separate point, which is what is causing these prices to move, which goes back to your original question. And the efficient market hypothesis, in a sense, is actually the conventional wisdom, which the media plays a big role in, which is that whenever a price moves, we attribute it to some news. And I personally am quite skeptical of that. I think an awful lot of the time, prices are moving for other reasons.
What kind of reasons?
Well, so, for example, this year is a very interesting example because you've apparently had lots of news that most professionals, including myself, would have expected prices would react to. Mm-hmm. So if, for example, you think of North Korea and Donald Trump, perceptions are that you've got this is pretty wild, gunslinging, erratic foreign policy. If you look at the kind of his behaviour in lots of other areas, your natural inclination is not that this is highly considered, well thought through, low risk foreign policy. If it has all of the opposite characteristics, at least superficially, and you think you have a regime about which we know nothing, that's highly unstable, which has nuclear weapons, you think they have engaged in nuclear testing. There's superficially, there's very clearly the potential for things to go very badly wrong. Now, if I showed you a stock price chart of South Korean equities, so South Korea would be obviously the economy most vulnerable to a major catastrophe there. Actually, South Korean equities have done exceedingly well, and you wouldn't be able to identify that anything at all had happened with respect to North Korea and the United States. So there's something curious, and certainly if you looked at broad stock markets, you would think this year has been a year of fantastically good news. So this is intriguing.
You're roughly equating good news with stronger share prices, stronger financial markets.
Indeed.
Because we should just unpick that last bit. Say, for example, in the case of South Korea, why would individual shares in South Korean companies be affected by global political?
Well, the way they would typically, so if you were to, if you'd said to most people there's going to be a major build-up in military tension between America and North Korea, in the past that's caused South Korean share prices to fall quite a lot. The rationale would be, well, it increases the probability of a recession, for example, in South Korea because people get very, very fearful. They stop spending money, they start hoarding, businesses don't invest because they're worried about what's going to happen, so profits decline. And the stock market is the value of profits, because profits of the underlying businesses, so the stock market falls. That would kind of be the conventional explanation. Or again, even if you think of last year, I think what was really interesting about last year, a crystal ball would have been disastrous to an investor, because if you'd been told Brexit, Trump, Italian referendum, most people's priors would be those would be extremely bad news for the stock market. So the perfect forecaster was a very bad investor, right? Because ironically, although they all caused temporary problems, cumulatively it had no impact. So something else is going on, which is very interesting. And yet, we typically latch on to these news events and focus on them. I think one of the very, very big factors that's going on is perceptions of risk. So it's actually how people feel about owning the assets and how those underlying beliefs and preferences are changing. And this is something that you don't really hear much about, people don't talk about. But when you think the way anyone is as a human being, it's an incredibly important part of our investment decision making. So if I was to say to you, what is the safest investment to make amongst housing, bonds, currencies, and the stock market? Now, most people listening to this will already have an instinctive answer. They haven't given much thought to risk analysis. They won't have done if you think of housing, they won't have done an analysis of UK demography and future house prices and price earnings ratios, but they have an instinctive feel about which of those. Most people in the UK are probably going to say housing is the safest. And the interesting thing is why. And that's largely because of their experience. That's because they know people who've made money. They themselves may have done well, or their parents. You wouldn't get the same answer in Tokyo. Right? Definitively you wouldn't, because most people they know have lost money in property and have gone into negative equity. Now, I think people's perceptions of the risks of assets changes. and it changes with the price itself. So I think one of the big factors that's probably going on in the world at the moment is people are perceiving stock markets to be less risky. So something is changing in people's perceptions of risk, and that is in fact causing the stock market to rise and making it somewhat immune to news.
So as stock markets rise, people feel that they are less risky, and so then they invest more, and then they rise further. And that, and second, it sounds like you have to have some kind of personal or collective memory of things going in a different direction in order to be able to believe that it would happen again. So in the case of South Korea, the thought of nuclear war is so dreadful that it's almost hard to factor that in. It's hard to comprehend. Or in the case of, would you say the same thing about here with Brexit?
Yeah.
Markets are just going up and up and up and up. Because we've never had a Brexit before.
Well, this is really interesting. Can I come back to Brexit in a minute? Because one of the things I think that's going on in the world is actually the memory of '08 is decaying. We're slowly forgetting '08. So if you think of it just like anything in human life, is we have traumas, whether they're associated with bereavements, with illnesses, with accidents, and those tend to be our sources of fear or anxiety as a reoccurrence of one of those traumas. Now, typically, distance from trauma, you are less worried about or less concerned. That may have nothing to do with proximity to the next trauma, which can come out of the blue. And markets, I think, human beings, they're still human, and they reflect the same sentiment. And so I think clearly, if you talk to investors anywhere in the world, you talk to people thinking about investing, very difficult to have a conversation today without people referring back to 2008. But I think they're starting to forget 2008. And the problem is 2008 was a disaster for the stock market. You know, stock market falls 50%. People lost a huge amount of money. They lost a lot of money investing in banks. And I think it's that memory decaying is starting to influence aggregate asset prices. And this is probably the main determinant of what's causing these prices to move.
So we've got two things going on in a sense. Then we've got the immediate responses to news on any particular day, and then you've got these underlying themes, the response to different things that may have happened years before or things that haven't happened for a while, and our emotional responses to that, as well as the kind of, I suppose, more rational ones, if it's
that's exactly it.
You said to go back to Brexit.
Yeah, Brexit. Well, Brexit I find fascinating because I think it's important to try and understand how human beings think about it and how human beings react to a problem like Brexit. And then you realise this exactly the same way that you and I react to Brexit is how, in fact, the Bank of England does, even though they have expertise. They're going to behave in the same way. And I think what most people do is, I was very interested in the housing shares around Brexit. So most people's initial reaction is, well, it's bad news at the level of the economy because it creates uncertainty. Firms don't know what to do. Workers don't know what the arrangements are going to be. People don't know what their rights are going to be in terms of where they can live. So whatever one's political views, the kind of economic effect of Brexit standalone is plausibly a negative one, at least in the short run. And so if you looked at housing activity literally the weekend after the Brexit, there was, people put all their purchases on hold. But within a week, people had kind of gone, well, it doesn't really feel like the world has changed very much, so I'm just going to get on with my life again. And which is, in a sense, what's kind of happened everywhere. There's a kind of, there's a lot of administrative consequences, etc. But people, broadly speaking, it's too difficult. And there's two problems here. One is, it's really too hard to work out what it means. I honestly don't know. Genuinely, if you said to me on a 5-year view, what's the implication going to be? I have no idea. I can see a lot of wasteful activity going on. There's a lot of duplication of things that we do with new things and new departments and the government being created, etc., etc. But if you really said to me, what's going to happen on a 5-year view, I really don't know. And so one human reaction to things where we don't know is pretty much to ignore them. So I kind of decide, okay, I'm going to ignore it. The other problem with it is it's what I call a single variable fallacy or a ceteris paribus fallacy. Apologies for the jargon. Really all it means is you analyze a complex system by focusing on one thing. Mm-hmm. So we suddenly say, What happens to the UK economy will be determined by Brexit. Well, it won't. It'll be determined by lots of other things. What happens to the global economy? What happens to UK interest rates? What happens to technological innovation? What happens to the different sectors of the UK economy? All of these different things. And in fact, it might be very, very difficult to discern the impact of Brexit in the context of all of those other changes.
Well, we will never know because we would never have. We don't have a counter.
Exactly. We don't know what the economy was doing. This is the thing. So when people say economists' forecasts are wrong, well, it's a bit disingenuous because economists' forecasts are always wrong. So what they don't tell you that, because we don't know how they would have been wrong anyway, right? So they're wrong. And part of the reason they're wrong is we've narrowed actually the range of error quite considerably. So in one way they're wrong. If you kind of rounded it to the nearest 5%, they're all pretty close, to be generous. But so I think that's how markets, and I think that's actually how the central bank. So if you look at what the Bank of England is now saying about Brexit, it's pretty much, to be honest, we're going to ignore it unless it causes some major upset, in which case we'll respond to it. And I think that's what most people are doing.
So then we go back to the beginning again. It's the emotional response that collectively no one quite knows what's going to happen.
Yeah.
And so what do humans do in that situation? Well, it could have gone. I think it could have gone either way. At the beginning, as you say, people started to put decisions on hold, markets did fall, the pound really has suffered. If that had continued, it could have snowballed, and we might have ended up with a response that more people were expecting.
Yeah.
But equally, it can kind of happen the other way, that if no one really makes any significant changes, then that continues as well. No one feels that they need to react either.
I think that's right, and I think the latter is kind of what's happened, and I think that is a very reasonable, understandable response to the level of uncertainty. And I think the interesting thing to me is that sterling has moved an awful lot. So the anomaly is the exchange rate. And that should be a stimulus. So personally, as an investor, taking a medium-term time horizon, I think sterling's quite attractive. Because if I look at everything else about the UK economy, it's very difficult to observe a Brexit effect relative to the rest of the world. So if I look at the level of unemployment in the UK, the rate of wage growth, rate of real GDP growth, productivity, some of it looks great. The unemployment rate is the lowest since the 1970s. There's very low levels of inflation. Most economists would have been, given their right arm to get those economic results 20 or 30 years ago. There are concerns about productivity, about inequality, about wage growth, but those are universal concerns across the developed world. They're not particular to the UK. So I must say, I can't discern a significant Brexit-specific thing that's happening in the UK economy, which merits such a big move in the exchange rate. But
Okay.
I could be wrong about that.
We'll find out.
Unfortunately or fortunately.
Thank you so much, Eric, for talking us through that, and
pleasure.
thank you for joining us for the big money questions.